Hi, I'm Michelle Lafreniere, the Director of Tax here at Profi 2020 Dental CPAs. When choosing a tax structure for a business, it is crucial to understand the main types and their implications. The primary tax structures are sole proprietorship, partnership, C corporation, S corporation, and nonprofit. As you'll note, I did not mention an LLC. A key distinction is that an LLC is solely a state legal designation, not a federal tax entity. LLCs are recognized at the state level for legal purposes, but must elect one of the above structures except nonprofit per federal taxation. The distinction is often misunderstood by business owners who believe that simply being an LLC dictates their tax obligations. For tax purposes, businesses must provide their EIN and supporting documentation to clarify their elected structure. So let's talk through a sole proprietorship. A sole proprietorship remains popular due to the simplicity and flexibility, especially in the early years of operation. Some of the pros include that it's easy to establish and maintain. Business income is reported on the owner's personal tax return, simplifying tax filings. And owners can take money out of the business with no tax consequences, as there are no basis limitations. Losses can offset other personal income, making this structure particularly advantageous in the startup phases, typically years 1 through 3. The cons can include that income is subject to self-employment, including years with a net operating loss. Unlimited personal liability, unless the business is structured as an LLC. Now let's talk through partnerships. Partnerships are versatile entities that allow for a range of income and loss sharing arrangements. Each partner receives a Schedule K-1, which reports their allocation of income, losses, and other items. This K-1 must be included on your personal tax return. Let's talk through the pros of a partnership. There are flexibility and distributions. Partners are not required to allocate distributions based on ownership percentages. For example, distributions can be split 75-25 rather than 50-50. There's also the ability to include partnership debt and basis, which allows for greater tax-free distributions. Fixed assets can be distributed tax-free, providing significant advantages in industries like real estate. Now let's walk through the cons. Active partners are subject to self-employment taxes on their income. Partners do not receive W-2 wages, but instead rely on guaranteed payments, which are not subject to withholding. This requires proactive tax planning to cover Social Security, Medicare, and income tax liabilities. Now let's dive into S corporations. S corporations offer tax advantages by avoiding corporate level taxation. Instead, income is passed through to shareholders who are reported on their personal returns. Each shareholder receives a Schedule K-1 as part of the Form 1120-S reporting. Now let's talk about the pros. One of the biggest pros is that income is not subject to self-employment taxes, which reduces overall tax liability. This straightforward structure with income losses are allocated based on ownership percentages, meaning they are allocated pro rata. Now, let's talk through the cons. The limited flexibility. All distributions must match ownership percentages, which can be restrictive when businesses with unequal contributions. Basis limitations. Shareholders' ability to take losses or distributions is tied to their stock basis. Assets distributed at fair market value typically result in taxable gains to the shareholder, making the structure less favorable for real estate or high-valued assets. Now let's dive into C corporations. C corporations, while less common for small businesses, have their own set of advantages and drawbacks. Let's talk through the pros. There's limited liability for shareholders. The corporate level taxation provides a clear separation from personal income. Now, let's talk about the drawbacks. Corporations are subject to double taxation, with corporate income tax at 21% and dividends taxed at the shareholder level, resulting in a combined federal effective tax rate of up to 41%. Distributions to shareholders are classed as dividends. There is a lack of flexibility and profit and distribution handling. Lastly, let's talk about nonprofits. Nonprofits must be organized and operated for public benefit with restrictions on private benefit or adjustment. Common misunderstandings include attempts to use nonprofits for personal contributions only, which is prohibited. These organizations face stringent compliance requirements, and failure to meet public funding criteria can result in reclassification as private foundations, limiting donor deductions. Selecting the right structure depends on the specific goals and operational needs of the business. Understanding the nuances of each option, from liability protection to tax implications, ensures better alignment with long-term objectives. Consulting with a tax professional is essential to navigate the complexities of basis, self-employment taxes, and distribution flexibility while optimizing compliance and tax savings.